you're in asset management. You're with Cadiz in Cape Town, sometimes in Johannesburg. But the reason I wanted you on to talk was that you were talking on Closing Bell last week with Eleni Jokos, the agony auntie, always looking for something to worry about. And you were saying profits have been too high. I think you were talking about the resources sector, and you were saying there's this thing about how profits over time revert to the mean, and if profit margins are too high, they can't stay that way, and you're feeling defensive and cautious, and you think it's an appropriate time to be lessening market exposure. So just explain to me how that theory works about, you know, mean reversion of profits, blah, blah, blah.
Look, for once, I wasn't just referring to the resource sector. I was referring to the market as a whole. But okay, yes, put the resource sector in there. And sure, profits are too high. Everybody else wants to come in, get a piece of the action. And that's about the time the market usually starts going down, is when everybody else comes in and the margins go down. And you can't pick on me about this reversion to the mean. That's just life. Huh? You're an engineer. Everything gravitates towards the center. Okay. If there's lots of profits, everybody wants to get involved. If there's no profits, nobody wants to get involved.
Okay, so it's basically the business cycle. It's this over-enthusiasm leading to over-investment, which leads to lower prices, which leads to too much competition, which kind of crimps profit margins and so on and so forth. Okay, I can get that much, and I understand that that would be cause for concern, but can one ever call where you are in the business cycle, and as a result, how would you know whether this is like the beginning of the downturn or whether it's just a little kind of inflection on your way higher and higher?
Look, I don't think anybody can call, Paul. I certainly can't call. But we can say we're in risky territory, we're in safe territory. If you're on terra firma Earth, it's pretty safe. There's a lot of oxygen here, there's nowhere to fall off. If you're on Everest, it's kind of slippery, there's not so much oxygen, it's a lot risky. And if you're in the stratosphere, there's no oxygen, you're going to run out of fuel. And without a doubt, you can say that about the market. There's a time when profit margins are hitting a maximum. I think it's just about 30%. And I think the minimum we've ever seen over 50 or 100 years is getting down to single digits, 5, 6, 7%.
And what kind of numbers are you talking about here? The global equity market, the S&P 500 or the JSE?
I'm talking JSE. That's where the average South African's got his money. So I'm usually talking South Africa.
So you're talking about compression and expansion cycles in the aggregate earnings of the total JSE?
Exactly.
Okay, but now this is where I begin to worry about this thing for a couple of reasons. I mean, if you talk about the business cycle, clearly that makes sense when you think retailers, banks, industrial companies, those that are correlated to cycles in expansion and contraction in GDP. But we know that there are sectors of our economy which are marching to a different tune. You know, I mean, resources, of course, does come to mind because that's got to do with long run cycles in terms of industrialization of Asia and stuff like that.
Look, let's give Eleni some credit. I'm a worrywart just like her. I'm probably in drag wearing men's clothes.
Me, on the other hand, not worrying about anything.
As I told Eleni when she said, okay, Pete, you think, take some money off the table, where do we put it? And I did suggest, spread it around. Go to some international markets, which are a lot cheaper than ours right now. Put some in cash. Not a lot, but put some in cash, which is offering about the same return as bonds right here, and it's a lot less risky. And I did say there are pockets in our market. Our market's got 400, 450 shares. There's probably only 150 you can buy. But yes, there are pockets. There's shares on this market that are down 40, 50% from where they were 2, 3 years ago when most of this market's up 100%.
Yeah. Okay, but I mean, let's focus on the resources thing in particular.
Okay.
I mean, the big cycles in resources were, you know, like World War II when they needed all the steel to make bomber planes or something. Then it went quiet for a while. Then Japan's industrialization in the 60s and the 70s. Massive boom, massive uptick in everything. And as a consequence of that, everybody got so excited about Japan and how it was going to change the world. They were buying up all the buildings in Manhattan. Then that kind of goes quiet in the 1980s. And we have this terrible commodities recession in the 80s and the 90s, which has now been completely sidelined by this enormous expansion in China, Brazil, Russia, India, everything. I mean, isn't it true to say that you can't just talk about cycles? You've got to have some kind of historic perspective. I mean, to say that the profit margins and the production levels are high in the mining business is to say that there's a lot of demand out of China. It's not like we've got this fully mature economy in the US, which kind of goes through cycles of expansion and contraction. What if we have this colossal expansion for the next 3 decades? And that's like selling out a bulletin now is like getting out, you know, 15 minutes into a 90-minute soccer game.
Look, Paul, I assume this program is about making money, not arguing philosophies, huh? My job's to make money. Clients bring me ideas, they bring me funds, they want me to make some money. Okay. Now, commodity prices might keep going up from here, but does that mean profits are going to keep going up? And share prices are related to profits. So if working costs in this country on the mines, especially platinum and gold, if those working costs keep going up 15, 16, 17% per annum like they have the last 10 years.
Yes.
Heaven forbid the gold price only goes up 5, 6, 7, 8% annum. That means margins are going to fall. That means profits are going to fall. That means the shares are going to fall. Right now, we're looking at profits that have only been this high twice. And I'm going back to when I was born, 1955. We had profits profits were a little bit higher in 1980 than they are right now. I'm taking out inflation, right? So in 1980, it's the highest profit South Africa ever saw. From 1980, we only got close to there in 2008. And boy, did we fall fast. But we've almost got back to where we are in 2008 now. So margins are getting close to as high as they were in 1980. And it's just so far above the norm. It is so far above any mean.
But that's what's got you worried.
That's what's got me
No, I buy that. I mean, my only other question, though, is it's not just about the absolute quantum of prices, but there's also the reality that the physical production is so much higher.
And
so
the
we talk
margins.
about Billiton, which is such an important player in our market. I mean, it's planning to double and redouble its iron ore production out of Western Australia.
Hey, I'm
so
planning
if they can
lots
hold
of things
those
too.
levels, if they can hold those levels, then the quantum of profits should continue to expand, no?
Yeah, it should. Take your pick. There's 1,000 fund managers out there. I'm flooded with them every time I open the newspaper. Take your pick on which guy feels lucky, punk.
Yeah.
But we're in stratospheric conditions
And
here.
your sense is one ought to be anxious because from here there's already a lot of good news priced in, and it's going to need a lot more good news for it to continue to head northwards.
Definitely, people are getting sloppy. These are fat margins. Most of these mining companies are seeing margins they've seen 2 or 3 times in 40, 50 years, and you get sloppy. You give the laborers double-digit cost increases when there's only 5, 6% inflation. You pay suppliers outrageous prices.
Okay. I got another challenge, though, to the theory, and that is within sectors of our economy, and I'm thinking retail here or financial services. I know you can talk about the business cycle, it goes up and down, and you can look at interest rates and you can look at inflation and you can get a sense of where you are in the cycle. But if you've got a fixation with mean reversion and profits, what do you do about companies like Mr. Price, which reported trading update today? It just continues to blow the competition away. In the financial services, you get these small mid-caps that just come up and they're like rockets. So my concern is if you were fixated constantly with mean reversion of profits, you wouldn't even go anywhere near those guys because you'd think there's no way they can sustain it.
Look, starting out, yes. Starting out, when I see these profits, I don't want to go near anybody. But we have to buy something. We have to put our money in something or we're not earning our fees. So let's look in there. And maybe Mr. Price is eating everybody else's lunch. Maybe he's realized the sloppy conditions out there because everyone's making money. So that's when you go behind the scenes. But I'm just starting with the all-share index or the Resi or the FINI or the Indy. Yes, just walking into any of those three, I'm terrified. You have to look in there and say, are there 1 or 2 mining companies who are going to double production over the next 5 years?
Smaller players coming through.
Yeah, somebody who is aware and cognizant of these special circumstances we're now in, and he's making a plan how he can sustain any kind of downward profit margin or price.
Okay, so caution, but there are opportunities out there.